It is our pleasure to welcome all the way from Hong Kong, Gary, to Equity Mates Investing Podcast. Gary, welcome.
Thank you very much for having me.
So, Gary, we want to start with your investment philosophy and the investment approach for the Asia Active ETF. So let's start with your investment philosophy. How would you define it?
Yeah, so for the Fidelity Asia Fund, essentially it's a very concentrated portfolio. We say typically 20 to 35 stocks. The reality is it's more in the low 20s. In fact, actually today we're at 19 positions in the portfolio. So we do like to take relatively punchy positions, put our capital where our assessment of companies is. The stock selection really revolves around three factors, right? You've got looking at fundamentals. So we're looking at how a company operates, the industry that it operates within. So how is that industry changing? How is that company, winning or not in that space? And then we try and distill it down to really decide how we're different to the market in terms of earnings, and also how this translates through to returns, which are potentially changing over time as well. So that's on the fundamental side. We spend a lot of time on sentiment as well. What's our assessment on how the market views a stock, or how the market is positioned? What is the market thinking compared to us? And really, what is the risk that our view, which could be different to the market, is wrong, right? And we spend a lot of time on the sentiment side. Obviously, things that pique our interest are markets or stocks that fall, and it comes into your radar. Quite often it falls for a good reason, right? So sentiment isn't just the only thing to look at, but it's like, right, what's going on? Has the market overreacted? If they've thrown the whole baby out of the bathwater, and then they're sort of, picked through the wreckage essentially overall. And then you've got to put it down to valuation. So we're always valuing companies according to our view on those factors, on sentiment and of fundamentals, and really looking at what our view on the valuations are over the next 1, 2, and 3 years, and how is that compared to the market, and do we think there's value in the company accordingly? That's on the, let's call it, the stock selection side. Of course, the other important factor is on portfolio construction, so like risk management and position sizing and such. And there's a couple of things that come to play here. Of course, you're thinking about liquidity and those types of factors, because that does matter. But we also spend a lot of time looking at correlations between the stocks in the fund. Make sure that there is, as best we can, have low correlation between all of the positions. In a concentrated fund, you don't want 6 or 7 stocks that are highly correlated, because that becomes a thematic bet, right? So we're looking for low correlations. So you have each individual stock kind of brings something different to the table potentially, and then ensures that stock selection drives performance, but at the same time as well, always assessing what can go wrong, where could we be wrong, what can go wrong, and as much time, in fact probably more time, is spent figuring out where can we be wrong and where can we be right, and that helps hopefully in falling markets protect you on the downside as well, because unfortunately markets do go down, so you have to be ready for that as best you can.
I love that description of your investment philosophy, Gary. I think there were some elements, like we've spoken to a lot of experts who speak about trying to find quality businesses, but I think far less speak about trying to understand what the market sees in a business, where the sentiment is, and where you sort of have a differing perspective to the market, because that's really where the money is made.
You're right, because you often hear about we're looking for quality. Of course, you want good quality companies, but you can make good money in companies that aren't high quality, however you define quality, but they're so cheap, so unloved from a sentiment perspective, that you just need things to get slightly less, slightly more love, slightly less worse, and you get a really, really strong re-rating. Now, they're probably not your long-term multi-year winners, but they're nice stocks to pick up and generate alpha along the way. And as long as you can really understand that, I think that you can sort of delve into those areas to make some potentially good money in areas that might not be deemed high quality long-term winners.
Can you help bring that investment philosophy to life through some of your fund's holdings? Like where is some of the stocks where the market might think one thing and you might think slightly differently?
Well, right now, think about the China consumer space overall. Now, China is probably, well, has been for a long time, everyone's underweight. It's been a market that no one really likes for a few reasons, which I'm sure we'll get into. But the China market, if we wind back the clock a couple of months, was on its knees, right? Sentiment was, I would say, in my 12 years that I've been here in Hong Kong, was the worst I think I've ever seen it, despite everything we'd seen in COVID and all these other things. It was really bad. Whilst with that really negative sentiment, we just got a huge amount of complete derating of the market, and it was just indiscriminate selling across the board. And it was almost a situation where China is uninvestable. That's what the market vibes and valuations and sentiment was telling you. And you just look across the board and say, well, actually, let's look at sportswear, for example, right? This is an area, last couple of years, they've had some inventory issues in the Chinese sportswear sector. Build up of inventory, a lot of discounting going on at the store level. That's a bad sign for the business. But come Chinese New Year this year, discounting is all but disappeared. Right, that tells you something. All right, maybe that inventory is being cleared out. At the same time, of course, we're always looking at the companies. You're looking at how companies are operating, supply chain management, brand management, and all these types of things. And someone like Anta Sports was a stock that's on our radar, came into this sort of valuation space where it just became so cheap that it felt like you didn't need much to go right for the stock to go right, and you start to buy into it. For us, a small position, about 1.5% to 2%, which is the tail end of the portfolio, but with the absolute view that in the China space, yes, the economy is not necessarily booming, but when you dig through the details, there are spots of the economy that are doing quite well. Sportswear, actually, funny enough, being one of those. If you look at retail sales for sportswear and leisure year on year, 12.5% year on year growth in sportswear and entertainment sort of sector. That's because people have been spending, but just not on the big stuff. People aren't going out buying cars, but are buying trainers, right, to go running. They're buying maybe a sports top. So there's stuff that's going on there, but the whole China consumer space just got derated. Everyone's given up, and then you start to pick through the wreckage, as I said, and you find someone like Anta. Anta's got its own brand, so Anta Sports. It's got its own stores. It also owns Fila. So it's, if anyone, particularly if there's any sort of European listeners, you may recall Fila as a brand from many years back. They own Fila in China, and they've got an outdoor brand called Arc'teryx as well. So they've been very good at sort of positioning those brands. People don't necessarily realize that they're Chinese. It's owned by a Chinese company either within China. It's something we think can make some decent money over the next 1 to 2 years.
So Gary, we're here to discuss Fidelity's Asia Active ETF. So we want to dig into some of the opportunities at a country level, but let's start at the higher level. Pitch the case to us why Asia is an exciting opportunity.
It's a dynamic region for sure, right? There's a lot of innovation that's going on, right? There's a huge amount of innovation that's going on, all the way from the absolute highest end, if you're talking about your Samsung Electronics, TSMCs, your Korean and Taiwanese tech, down to, sort of, let's call it lower sort of value add, but still innovation in parts of the market around the ASEAN region, India, and of course China as well. There's a lot of dynamic innovation that's happening. You've got a huge population. The demographics in markets like Thailand and China aren't great, but therein potentially lies an opportunity, right? Because as demographics worsen, there are always some winners and losers. But then you've got really strong demographics coming through from other parts of the region, like India and Indonesia, and they can create sort of long-term economic development opportunities as well, which you look at, but you have to bear in mind from an equity market perspective, understand the valuation of those types of stocks as well, because sometimes the market is also aware of those too. So there maybe not so many opportunities at the moment. So you've got sort of a dynamic region, you've got interesting sort of population demographic opportunities, and then you've just got a lot of companies to pick from. Now, as I said, at the moment we're looking, we always look around for around 20 companies. China alone is over 4,000 listed. Absolute huge amount of opportunities from a stocks perspective to buy into, and it's something that we're trying to take advantage of.
Now, look, we recognise that why Asia is a big question when, the world's got, call it 8 billion people, and Asia has more than half of that population. Like, it is at some point we'll stop talking about it as a region and start talking about the sub-regions because it's
Yeah.
just so big. But not in this conversation. We're still going to talk about it as the continent as a whole, or the region as a whole. So you've just made the case for why Asia. I guess the adjacent question when we're talking about your active ETF is why active management over passive indexes for the Asian region?
Part of this is thinking about your time frame. If you think, right, okay, we want to take advantage of a market that we think is going to go up in the next 2 months. I'm not talking our own book here, but an ETF, okay, jump in and then jump out quick. But if you're looking at this as a potentially longer term opportunity, maybe 2, 3, 4, 5 year opportunity, you do want that active approach because, as I said, it's a dynamic market. Things change very, very quickly. And unless you're on it all the time and consistently being able to look and trade, you kind of want someone else to do that for you. And also within that, you can have a really poor market, a poor performing market, but you can have some really good stocks in there too, which active managers can buy into. So there's always an opportunity to make money regardless of the market conditions from an active management perspective. In terms of ETFs, again, it depends on your time horizon and such as well. They can be an opportunity, but from an active perspective, we're always on the ground looking at the companies and trying to avoid the bad as well as buy the good. And that's where you can make as much money by avoiding the bad as well as buying the good from an alpha generation perspective. An ETF, you get everything. So you get the good, the bad, and the ugly. We can, as best we can, avoid the ugly and the bad and buy the good on an active space. And I think if you look over the if we take our Fidelity Asia fund, over the last 10 years, we've been managing this strategy in terms of managing it in this highly concentrated way. You're looking at sort of circa 400 basis points outperformance net of fees over per annum. So that's where the value is in an active approach, potentially over an ETF.
You said there, Gary, that you're always on the ground and looking at companies, and the development story in Asia is certainly one that needs to be seen to be believed. What are some of the common misconceptions that you hear about Asia from potential investors, and I guess compare that to the reality that's on the ground? And if you could use some specific countries as examples, that'd be great.
Yeah, I think the biggest misconception is China. It's the big country in the region. It's the biggest market. It's also the one that I think people have, at times from the outside, less insight into. And also probably, actually, you definitely see this, outside of the region, outside of the Hong Kong sort of China region, the news stories that you get are always almost 100% negative. There's very rarely any sort of good news stories that emanate from about China. So I think there's a big misconception just generally on China. And one of those being, which really came to fruition at the back end of last year and early this year, is just that China's uninvestable. That's a question that it's been coming around a lot, is China's uninvestable, you can't make money, there's no point type of approach. Well, actually, as I said, there's over 4,000 listed companies for a start. There's always a money-making opportunity. But there is a huge amount of dynamism, going back to my point of being dynamic. There's a lot of dynamic companies that are always out there trying to work to generate returns, to grow their earnings. And for us as investors, that's a really interesting spot to be in. There is, of course, always that risk. There's political risk. You have to factor that in. But you can never avoid it totally. You can never avoid it totally in any market, but you can look to mitigate as best you can. So look for companies that are domestically focused. Look for companies that aren't, reliant on international trade and could fall into scope for tariffs and everything like that. Look for domestic companies. Look for companies that aren't operating in areas that maybe has a big impact on sort of the social stability of the economy overall. For example, banks. You just know that banks are state-owned. They're going to be working on behalf of the government. They're going to be maybe doing what's best for the economy, which doesn't mean it's necessarily the best for equity investors, right? So just look for companies that don't get involved in that sort of world, and they can operate and avoid some of those political risks as well. So I think China being uninvestable is a huge misconception. There's a lot of money to be made in China and a lot of opportunities. And did anyone know that year to date, the HSCEI market is outperforming Aussie equities, US equities, Japanese equities, Indian equities year to date?
Know that.
The HSCEI market's up 35%.
And for
since late
people
Jan.
who are
So-
unfamiliar, that's the HSCI is the Hang Seng, which is the Hong Kong index.
the HSCEI, the Chinese companies listed in Hong Kong.
There you go. It's outperforming everyone.
It's outperforming everyone. And since late Jan, the HSCEI index is up about 35% or so. It's somewhat turned. We can't say that this is, it's going to go up
Yeah.
all the time.
Yes.
It is a market. So, but it's not uninvestable. And I think that that's something that people have missed because they've just been caught up in this negative sentiment, negative news, thrown it out the back door, not interested. And now you look 3-4 months later and you think, what did I miss? And a lot's gone on.
China's a misconception, and China's growth story in our lifetime has just been phenomenal. It'll be one of those things that we look back on and it was like profoundly change the world. It feels like India is kind of having a moment now, maybe not quite the growth story of China, but certainly from an investing point of view, it seems to be where a lot of the focus is in the Asian region. If you were to anoint a country as sort of next up, or a couple of countries as the ones that you're watching as, the right mix of demographics and economic dynamism and investment, where are you looking and who are you backing?
You have to think of your time frame. If you're looking 10, 20 years, let's call it generational time frame, it's hard to look past India. The demographics, as you said, is great. I mean, there's a big population now, bigger than China. It's a young population. So there's a lot of opportunities there for that sort of economic development story. So if you can play into that, that's a great opportunity. The trick there is if it's a 20-year investment, put your money in now and just try not to look because it will be a bumpy journey potentially. If you're looking shorter term, there may be some more legs to run on the China story in the shorter term from where we are right now, but there are a lot of risks, right? And I've talked about the good stuff. There are risks to this, which we can get into. But it just feels at this valuation level where China is trading below its long-term historical valuations, where sentiment has been really negative. You just need things to just get slightly better and you can get a bit more sort of juice in the tank from the China market. But there are a lot of risks. There's a lot of risks around the property market, which is the absolute massive elephant in the room. But if they can sort of start to put a floor, let's say the policymakers, can start to put a floor on the property market in China, it creates a really strong base for potentially shorter term performance overall. It's hard on a longer term view, 3, 5, 10-year view, to look too far beyond the tech giants, the TSMCs and Samsung Electronics of this world that are front and center of what seems to be let's call it the new revolution of AI and such. They're really a big part of that, and those types of companies can play a big role in long-term structural opportunities in the tech side too.
So one country that I get particularly excited about, and especially sitting here in Australia, it feels like it is so under-watched and under-reported on. It's literally the country with the 4th largest population in the world, and it's right on our doorstep, and most Australians don't think about it, and that is Indonesia. Do you have much of a view on where Indonesia is and where it could go? And I don't know if you've invested in it in the fund.
We have invested in the fund. We've got one Indonesian stock right now, a company called ITMG. The demographic story is very interesting in Indonesia. The challenge here is it's however many hundreds of islands, and the infrastructure needs to improve somewhat to really capitalize on the resources that they've got and the population opportunity that they have. There's been a lot of talk around, will Indonesia take on sort of, let's call it the manufacturing role that China potentially had, being an assembler and such. There is of course a great opportunity there, but if you build a an assembly plant on one of these Indonesian islands, let's call it Java, for example, or somewhere, you need to make sure that you've got the whole supply chain near you to be able to really capitalize on that. Otherwise, you're just importing from all over Indonesia and from other countries as well. And maybe, is that cost efficient or not? And I think the infrastructure is a bit of a problem somewhat for the development of the economy sort of going forward. But the demographics, as you point out, are fantastic. They've got a lot of resources. If they can get the money, and this is sort of politics really, if they can get the money in the right space, it's great. From a market perspective, for us, there are good companies, that we've liked and often looked at the banking sector, for example, some high quality banks, and the banks will be a big part of that development story going forward. But they're also, they're well held by international investors. So you need to just get one policy misstep and you could get a lot of flows out of those stocks, which could drive a bit of a derating. But beyond that, there's really probably a lack of liquidity at the moment still in that market. And to really, for us to get into that market, we need to see a bit more broad-based liquidity sort of coming through, and those companies coming through. That being said, yep, you're right. On an economic development perspective, it's got a good chance, shall we say? It's got the right ingredients in place.
That's interesting. So Gary, we want to turn to a couple of deep dives on some stocks in the portfolio that I think illustrate the philosophy that you spoke about, the three factors around how the company operates, its industry, your view on earnings, and then also, I guess, the sentiment and what the market thinks about it. So you've bought a couple for today. Let's start with Samsung. So can you just give us a refresher on what Samsung is, the business units within it, and then we'll go from there.
Yes, so Samsung is, as you'll be aware, essentially a big sort of technology conglomerate, really. It's got three main sort of segments of its business. It's got the consumer electronics, which I think most people will be familiar with, the televisions, the smartphones. So that's a big chunk of their business. They've got memory, so sort of high bandwidth memory, so DRAM and NAND memory that they're in, which we think, and for us, is a really interesting part of the business. It's what probably attracts us to it more than anything. And it's got an increasingly growing sort of foundry business, this sort of, sort of microchip sort of foundry business, which is probably sort of mid to high single digit percentage of the business overall, but in time could be a growth area as well for the future. It's got a bit of an option on the company. What's attracted us to the company? Well, actually, we've liked for a while SK Hynix. So SK Hynix in Korea is a pure memory player. So they are all about memory. And I think you may be aware memory is very, very important for like the new age AI servers and such. So NVIDIA get their memory, their high bandwidth memory from SK Hynix predominantly for their sort of GPUs and such. That stock, SK Hynix, has done exceptionally well, right? It's done very, very, very well for us. It's got to a point now where the price to book, though, is trading at really very, very high levels to where valuation starts to get a bit shaky for us. And everyone knows about it. Sentiment's really positive, and that's when we start to trim. Samsung's lagged SK Hynix, partly because it's not a pure play in memory, so that's understandable. But something that we've started to get interested in is that Samsung themselves have kind of essentially put their hands up and said, SK Hynix has led the way on high bandwidth memory. For various reasons, we've not been up there at the top table, but we know that the likes of NVIDIA need another supplier, another high quality supplier that can provide this high bandwidth memory in a big way. Samsung's been putting a lot of investment there. In fact, I think this week they've just announced a brand new head of memory, which is considered a bit of a big hitter in the memory space. So they're making very strong moves to move up the value chain to become potentially another supplier to NVIDIA. If that happens, you could get a really strong re-rating of that stock, and the valuation differential between Samsung and SK Hynix could close. Now, sentiment, I would say, is not negative on Samsung. Everyone knows, it's a well-known company. I think everyone knows about Samsung, but a lot more focus, I would say, has probably been on SK Hynix because of the pure memory play. And as I said, we've been trimming that down and in favor of in favor of buying into Samsung Electronics from here. A couple of other bits: deep pockets, strong balance sheet. They've actually been, using some of that money to purchase land in, sort of, let's call it cooler mountainous areas in Korea, so they can start to build out data centers. So they've got all of those things because you need cool temperature to keep the temperature of the data centers down. There's a few things that they're doing which we think are really quite smart moves for the long term sort of growth opportunity for that business. So for us, Samsung is one right now that we've held for about a year now, but one that we've been adding into in recent months as I suppose an ongoing play into that memory cycle that we think is really interesting.
It's fascinating, and it's one where like Samsung is such a business, and like it's so big, it's so established, it's got all these well known and well understood business units, and then you're sort of talking about the thesis being around a sort of up and coming area of their business. When you're sort of building an investment thesis for the whole company, like how do you sort of balance what's going on in perhaps the slower growing, more established parts of the business with this new and exciting opportunity?
The slower, dare I say, more boring part of the business would be the electronics, televisions and such, commoditized, volume play, relatively lower margin, but you can see that as a stable cash flow into the business, right? It's a defensive part of the company, which creates a bit of a more defensive support for the business. Yes, okay, there's a cyclicality to people buying electronics, of course, but these are products that need to be consistently replaced by consumers. So you've got that type of part of the business that you would just look at the stable cash flows potentially, or how stable those cash flows coming in, and how that cash is used to potentially reinvest to other parts of the business like memory. So you value it accordingly, and we like to look at valuation metrics like price to book for something like Samsung.
So Gary, we'll move to the second company, which is Galaxy Entertainment. So let's start at the top again. What is Galaxy Entertainment? What it does, bit about the history, and then we'll go into the thesis.
Yeah, so Galaxy Entertainment is a Macau casino operator. So if you go to Macau, Galaxy, there's a Galaxy sort of property overall, but they also own a host of other brands on the Macau Strip as well. So they've got quite a prominent number of properties in Macau. The Macau casinos are a hotbed for tourism, right? Particularly Chinese tourists coming over who like to splurge a bit of cash. So there's a lot of foot traffic that goes through the doors in these. Now, Galaxy themselves are what are considered a locally operated and locally owned casino operator. So if you go to Macau, you've got your MGM, which is owned. The listed entity is MGM China. You've got Sands, and so it's Sands China. So these are US sort of owned, if you like, companies at the highest level. So they're parts of the Las Vegas counterparts. Galaxy, being a locally owned operator, maybe in time may get sort of, let's call it, will maybe get a favorable view from the local regulators and such, if we ever get a geopolitical issue, which obviously is a risk as well, because the local regulator will give out the licenses for tables, licenses for new properties to be built, and other such things. So there's a potential sort of just home advantage that Galaxy has. Why the Macau casino operators, though, and why Galaxy in particular? Well, aside from the fact that it's just it's got that local flavour to it, which could be potentially interesting. It's got very, very strong brand, and it attracts a lot of mass gamers, as we call them. So not your necessarily your very VIP high rollers, but the mass gamers that come in and still spend a decent amount of money on the tables. But it's not just money on the tables either. They've been looking to create what they call sort of an integrated entertainment hub. So K-pop bands that might come into the region will more than likely have shows in one of the Galaxy arenas. Big time singers in China and such, they will be doing shows there as well. So there's more strings to the bow than just gambling. The other thing as well for Galaxy, and why we've been looking at it in particular more recently, is that the China consumer, as we talked about earlier, has just been completely sort of decimated by investors. There's been a view that China economy is not coming back. Chinese consumers got really negative sentiment. Don't disagree. But we've got to a point now where Galaxy's valuations are actually similar to what they were during COVID. During COVID, no one was going through the door. Today, they've got a lot of people going through the door. So you're looking at a company that's trading at the same valuation levels as they were during COVID, but actually different to COVID, they've actually got people coming in and spending money. And you just start to think there's a misalignment here. The top-down view has been driving sentiment. The top-down view has driven down valuations of this company, but actually fundamentally, we think over the next 1 to 2 years, you're going to see some decent free cash flow yield coming through from the company. You're going to be seeing some earnings growth coming through as well from these levels. So an opportunity we think that we were buying into earlier this year, and let's see how it plays out.
When you think about investing in China, you obviously do have to think about the government, and we've seen certain industries have crackdowns at different times. The one that comes to mind is the video game industry a couple of years ago. And Macau, for me, I've never been. I would love to go. It just sounds wild.
Put some bets down.
But it feels like at different times it's been loved, and at other times perhaps not so loved by the central government. What's the relationship with it now, and how do you factor that in when you're thinking about risks?
The part that's not necessarily been loved, if you like, is the real high roller part, right? So Galaxy in particular plays in that more mass, that mass space. So it's accessible to, not to everyone, but accessible to most, right? And I think if you've got that and you open your doors to say, right, everyone can come in, we've got entertainment, we've got restaurants, we just have a good time, you have a holiday, you go to the swimming pools and those types of things, you get you get slightly more love, shall we say, than if it's just an elite kind of, you need to be a multi-millionaire and you've got to spend all this money type of approach, which maybe some of the other operators have done. So I think that's one area in particular. Of course, there were some issues quite a few years back now, but around, let's broadly call it money laundering, and people, they call junkets. So trying to sort of put this into a short way, but essentially there were travel agents maybe in Shanghai that said, okay, we'll give you, we'll get you a room and some money for the casino table, give us, let's call it $2 million for it. And then they turn up and then they've got $2 million of chips on their bed, and then they can just cash that in, and then it's sort of getting money offshore in a roundabout way. That was kind of an issue. That was something that's been cracked down on a lot, but they weren't necessarily the casino operators. It was what they call junkets that were happening. So that's where the crackdown really came. The casino operators themselves weren't involved in that. But what we've been seeing though is less of a sort of less of a focus on those types of things, more of a focus of opening the doors up, getting people just to go off and have a general holiday, which you can definitely do there. But of course, there's always risks. And one of the other risks, of course, is around table licenses, because you can't just set up a table. You need to get licensed and all these types of things. But the licensing concessions have gone through more recently, and it'll be something we need to look at in 5 years' time now, I think it is. So it's that kind of risk has passed as well.
So, Gary, before we move off China, we would be remiss if we didn't ask you about what probably has captured more headlines than anything else, which is the property sector. So, what's your view, and I guess what is actually happening on the ground?
For good reason, capturing a lot of the headlines. It's been tough. The property market has not performed. It's been, I'd say, in the doldrums. You just have to look at recent property prices; they continue to fall, and that is the big elephant in the room when it comes to China. The China property market has been pulled down, shall we say. It's created a lot of negative sentiment, not only to the property sector, but it's had a knock-on impact on the economy. It's had a knock-on impact on consumer habits as well. A lot of people's wealth, same as everywhere else, is tied up in property. So if your property is going down, you don't feel wealthy, you're not going to go off and be buying that new car. And we were in this camp as well. I think a lot of people felt that the government would step in a bigger way and sooner, and they've actually held off for a couple of years, which I think has been a big part of some of this negative sentiment towards China as well. So you could say that the negative sentiment we've seen has been somewhat justified. However, in recent months, we've started to see some potentially positive moves here. China property market, you can think of it on the nationwide level, and you think about it on provincial level as well. So you've got these big cities that, let's be honest, the size of small countries anyway. They're starting to put through provincial level changes around to encourage property buying, essentially. Changing rules around people buying second homes, changing rules around the amount of down payment you need to put in for new properties. So it's having a marginal effect, but we need to see how that plays out. I think more importantly, as we're recording right now, last week the Chinese government announced what's being described as a rescue package for the property sector. They're pledging 300 billion renminbi to what they call relending loans to state-owned enterprises and local governments. So basically tens of billions of dollars to SOE, state-owned enterprises and local governments, to go around and use that money to buy up inventory, so buy up properties that haven't been sold. The idea here is that you clear out that inventory and you create a floor in the property price, and it creates potentially a base then for property prices to go up and the economy to get back up and running, new developments to happen and such. It's arguably a tipping point, right? If the devil is in the detail, so they've pledged this money, we need to just see what that actually looks like in reality. And we also need to figure out and see, once these properties are bought up, what's going to happen to them. And if you just buy them and leave them empty, does it actually mean anything? So let's see how that goes. But I think more importantly is the messaging. The messaging is actually the government is here to support. So that's something that the market is taking positively. The devil, though, as I said, is in the detail, and we need to see how that actually plays out. And it could be the tipping point. If it's considered, a program or a package that can genuinely create a floor in the property market, then we could be looking, for quite a positive outlook. If it becomes a bit of a fly-by-night opportunity, it's like a damp squib, then we might be back in these negative doldrums that we've seen. So it is quite, I think, an important tipping point, something that you need to monitor. But the market has responded well, and we've seen property developers in some cases go up 40-50% in the last sort of 2 months or so on the back of this. Does that mean that people are a bit overly positive? Very quickly, that's something we need to figure out. Maybe a big indicator to look at is in July. There is this what they call a third plenum. It's the government has announced this third plenum, which is an economic conference, and they specifically mentioned the property market in that. No details, but I think July might be a very interesting opportunity to see how this money may be put to work, and maybe any other packages that may be put together as well. So it's a fine balance. China's looking the market's looking good right now. The economy needs to follow to catch up. The property market is definitely front and center.
Well, Gary, that does bring us to the end of our podcast today. We just want to say a massive thank you for coming on. No doubt the Asian opportunity is one that we continue to explore more, because the opportunity is an exciting one. So if you're interested in finding out more information about Fidelity's Asia Active ETF, we'll put a link in the show notes, or you can head to fidelity.com.au to find out more information. This is one of 4 active ETFs that they've recently launched. There's one for India, there's a concentrated Australian equities, and a global small and mid-cap active ETF as well. So backed by over 50 years of investment experience. So a huge thank you to you, Gary. Took a lot out of that episode, a couple of really interesting stocks there to close, and appreciate your time. Thank you very much.
Equity mind.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.